Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending March 10th, 2017. What I have on the screen here is a 2-hour chart of the E-mini S&P 500 futures. And I'm focusing on a 2-hour chart on a couple of our major indices because next week we have the FOMC. Janet Yellen, we call her fondly, aka Aunt B. She's going to be bellying up to the podium, and she's going to talk about the Fed's expectations for the remainder of 2017 and just where do they sit, dovish, hawkish, neutral, regarding future interest rate hikes. Now remember, the Feds have, according to their dot plot, indicated 3 rate hikes for this year. The markets have priced in 2. The reason why the markets have underpriced potential rate hike is because in December of 2015, when the Feds hiked the rates, they had projected 4 rate hikes for 2016, and as you guys know, we only had 1 rate hike in December of 2016, just a few months ago. So the Feds have now come out this year and priced in 3 rate hikes, and of course the Feds generally never get any kind of forward projections correct. They, at least over the past 8 or 9 years, they've always missed. They've always overshot as far as potential rate hikes. The markets always come in and backfill it by cutting their potential rate hikes less. So all of the price action that we're seeing in the markets right now have already put in a rate hike for this March, this next Wednesday, when they meet Tuesday and Wednesday. Wednesday's when we come out, we get the word at 2 p.m. New York City time, Eastern Standard Time, and then at 2:30. Aunt B steps to the podium and she gives us her recipe for blueberry pie. And her blueberry pie, it's either going to be very tart, not a lot of sugar, and not a lot of butter, meaning it's healthy, meaning she's probably going to be very hawkish, or it's going to be very dovish. Now, Yellen has been dovish over the past 8 years, but I suspect this time she may surprise folks and come out and become a little bit more hawkish. But the reason why I'm focusing on the press conference versus the 2 p.m. rate hike, because the markets have already priced that in. And where the markets are really going to be paying particular attention is just, where do we go from here? This is a situation the Feds really like. They like to come out and talk about a potential rate hike and get the 30-day Fed Fund futures. There's a tool by CME that you could use that'll give you the probabilities, and we're over 90% right now. So anytime you get over 50%, just kind of a rule of thumb, the Feds have a green light to raise the rates without undue noise in price action when they come out with it. But now we're at 90%, so this is almost an assured deal of a Fed rate hike this coming Wednesday. But again, what are they going to do afterwards? Now, if she sticks to the script of 2 more potential rate hikes for this year, that would be 3, and she's got a little bit of a hawkish tone to it, we're going to pay attention to some key price assets, and we want to follow what these price action does, because no matter how much you think logically what price action may do from a rate hike, you never really know until prices react to it. Thus far this past year, or last year rather, we haven't, price action has been wrong, estimates have been wrong on everything from the Brexit vote to the Trump administration win or the Trump presidency, and then price action quickly reversed itself. So logically you would have been short going into the Trump presidency, and you would have stayed short, but then you would be underwater dramatically. So price action moved up. Same thing with the Brexit. So now what I've got on the screen here, as I said in my opening, is that a 2-hour chart of the S&P 500 futures. You can see on this chart here, I've got marked a couple of key levels that we're going to be watching. The first is 2401. Again, this is the futures for the S&P 500. This is the all-time high. It's the 2017 high. You can also see that I've got a couple of numbers underneath here. This number right here and this number right here, or key price levels. You can see here key pivot levels that if we break then there's not a lot here holding us up to take us down to 2,300. All right, and I have said that this is a really good psychological point, as well as where markets hung up a little bit last year, and it would be a great stopping point. You can see the price over volume, or volume over price is probably the best way to do it. We've got a lot of, there's a lot of buying versus selling. There's a big battle going on right now, buyers versus sellers, and we're at a stalemate. This stalemate's going to be released, and we're going to move hard up or hard down, I believe, midweek going into the end of next week, based on what the Feds do. And don't think you can guess, because sometimes I've seen price action go the other way. Okay, so the markets are a little bit coiled up right here. You can see from the high that we made back the end of February, we've done nothing but work ourselves off, and we've got a little bit of this pattern going on right here, if I kind of do it like that. And this pattern here, even though it is a descending triangle, you can see here that the odds favor a break to the upside, and the break would be essentially, the measuring objective would be very simple. The measuring objective would be the width of that triangle, which would put us right about in that area right there. And it would take us up to about 2450 should we break. So, you know, you've got that right here, you've got the base right here, like that. And then a breakout would be, we just add this on here like that, and then we would take us up right around here, 2425, 2450 area. But then by the same token, a break down here takes us right back down to the 2300 area here. So this is what I'm going to be watching for next week. The really interesting thing is, it's been a very orderly pullback. If I'd had told you that we would have hit 2401 March 1st, and now we've given up, you know, almost 35, 40 points, you know, and in that time, volatility has stayed subdued, even pull back a little bit. You probably would have said, no, I don't believe it. But volatility is very subdued. But we're going to get some activity by the middle of next week. This activity is going to spring up. And I think most markets are waiting, not so much on whether there's going to be a rate hike or not, but probably, are we going to get more of a hawkish Fed, and they're going to be more prone to hike the rates again. Now keep in mind, after March 15th, the Feds don't meet in April. They meet in May and then in June. So we've got a rate hike coming, which I believe, and then we're going to have a stand down from the Feds for over 60 days. So this is the last chance, and they're probably going to be more hawkish than bullish, or than dovish, and then that's going to precipitate, you know, how the price action works now, or moves. And because the markets have only priced in 2 rate hikes, and if they get wind that the Feds are still hell-bent on 3 rate hikes, or even possibly more, whatever it takes. And Yellen is not going to say exactly what they're going to do, but you're going to read between the lines of her press statement and the way she answers her questions. And price action is going to make its own determination of bullish or bearish or hawkish versus dovish for the Feds. So we use the 2-hour chart because it's a great chart for a weekly time frame, and all I'm really concerned with is how is the market's going to react for next week. Traditionally, we get a reaction and then a counter reaction, because if you look at the jobs report, which was really the last report that could have possibly derailed a potential rate hike, look at what happened at the jobs report numbers at 8:30 in the morning. This is a 15-minute chart, guys, and if we look at right there in that area there, that is from the jobs report release right here. It came up and then it sold off a dramatic amount. Okay, I mean, from the peak of the markets, we were right around 2376, and then if you look at where the bottom was, it was around 23, let's call it 2360. So that's about 16-point move. And then we came right back up and closed right in the middle, about a 50% move off the lows here, given the range that we went from low to high during the day. So, but we still, and we finished in the green, but not where we were as the markets, and we actually moved into the red a little bit for the day. So that is this pattern right here tells me that the markets still are a bit nervous coming into the potential press conference that Yellen is going to do. So I just wanted to show you this 15-minute chart here on how the markets react. Now, the other thing that I want to do is I want to come back in and let me show you another chart, which is, well, let's back out for just 1 second. Let me just catch myself. If we come out to a daily chart on the S&P 500, you can see here that, again, this pullback that we've had has been very slight, all right? Not a lot. And if you look at it like that, it almost looks like a bull flag. And like I said on that 2-hour chart, you know, you measure the distance right here of this, and we do a breakout, let's say right here. It takes us right up to about right here, anywhere from 24.25 to 24.50. So this is kind of, you know, where we're sitting. But at the same time, if you look down here, there is absolutely zero bullish or bearish divergence, what we call a bed. And that's why I said any pullback here, we're a buy on a dip environment right now. You can see the 200 EMA and the 50 EMA both have upward vectors. You can see this 2300 area here, which is where I called for the most likely pullback should we get one. And remember, we've gone over 103 trading days without a 1% pullback, right? We have not had a 1% pullback in over 103 trading days. This is the second longest on record. And 1% is not much. I mean, it's only 23, 24 points, S&P. But you can see this upsloping trend line right here. And I say as these things converge, and we're going to test that area, which is also the 50 EMA. So that's kind of what I'm looking at right now on this daily chart. But let's go take a look at another chart, which I found very interesting. And let me come back down to the 2-hour chart here. And by the way, going back to the daily chart real quick, I want to show you the opening price of the S&P 500 for the year. You can see that this is where we open right here, 2240.75. All right, and we're a good 110, 120 points north, sitting like that right there. Okay, a good distance above. I mean, that's a long distance. But now let's go take a look at the Russell futures. If we look at the Russell futures, check this out, guys. If we blow up and look at the Russell futures, and I'll just widen the screen here so you can see, we actually, over the past 2 days, have moved into the red for the year for the Russell futures. I mean, look at that. The opening price right there is at 1360.30. We've been in the red. So for those of you that are not paying attention, the Russell has been doing one of these kind of numbers like that. I mean, that is a very tight channel to the downside. That was a gradual slope, and we broke it, and then we made new highs like that. This is a very tight move, and we closed just barely in the red for the year for the Russell. And remember, the Russell is a small cap and mid cap. So this is one of those things that we've got to watch. If the Russell breaks down, and remember, I told our members, watch the rut, the way it handles the 50 EMA. Right here, you can see the 50 EMA. The rut moved below it, but always managed to close above it for the day, right? But not until right here, we've made all these closes, and now it's showing a lot of signs of weakness in the Russell. This is a small and mid-cap index, so if this gives it up, it could portend things to come for the E-minis and the Dow and then Nasdaq. And of course, Nasdaq's our strongest one. If we come over here and look at the Nasdaq futures, that's the one that is extended the most. and let me just find it here on my chart. Okay, here we go. Here's Nasdaq. Look at the actual 2017 open price for Nasdaq is very near the dot-com bubble highs, right around 48.84 area. And look how much, and we're bumping up against the 2017 highs, right? Like this. And we've got on this daily chart, we've got the vectors of all our moving averages pointing up, every single one of them. And there is absolutely zero, and I mean zero, bed on this. In fact, it's getting stronger. So this is why I said we're in a buy and a dip environment, because any pullback here based on this charting right here is going to be a buying opportunity. And the 50 EMA is well south at 51.97 on the Nasdaq futures. But look how far away we are here. So this gets back into where we were about 4 or 5 months ago when Nasdaq really went on a run and the Russell lagged dramatically. And we looked at a pair trade where we were selling the Nasdaq, right? And we were buying the Russell, and we were playing the gap between the two. I think that trade to me could be a very interesting trade. The Russell being the underperformer, Nasdaq just totally outperforming. I think there could be some really interesting play between those two in a pairs trade. Now, if we look at volatility, and we'll look at the VIX here. The VIX closed Friday at 1166. VIX isn't going anywhere. We're in the green zone. We're near the 2017 lows, and it's just this pattern that you see in the MACD is nothing more than a consolidation pattern, which of course that's what we are, right? But remember, when you're down in this area, you've got to be concerned about these spikes like this. But we've been in the green really since right after the Trump election. As soon as Trump was announced, the markets took off. And you could see that big spike in the volatility of the VIX. We were up in the 22 area leading up to the election, and then it sold off. And now we've been down in this area here, all on the basis of the policies that the Trump administration wants to get through, which are very pro-business. Now, should he slow down in any of these, you're going to see vol start to move. But right now, we're kind of in a benign environment. Now, the question is, could Yellen pose an obstacle to all of this with her press conference if they come out and they are too hawkish? Well, I think longer term, no. If Trump gets his policies through, we'll see probably 2 or maybe even 3 rate hikes in 2017. But if the Trump administration gets through those things, the trifecta, which is the tax cuts, the less regulation, the repatriation of money back from offshore here, infrastructure build out, I mean, you're talking a lot of stimulus. And that stimulus is going to find its way into the equity market. So that's why I am still kind of a buy on the dip kind of trader right now. And then, of course, the other ones that we want to pay close attention to is treasuries. Look at the bond market. The bond market made new 2017 lows right here. Let me just highlight it and move it down. And it's coming right down to my projected point, which you guys, for those of you that are watching this every weekend, you know, right around 145 is what I'm projecting right here. So this is the projection of where I think the bond market is going to move. Now, it's been in this choppy range. We broke out of this range. It was a rather wide range. But the other thing is money is clearly moving over into equities. And I said bonds are really going to start to give it up and probably even go through these in this range here, or that support zone there. Bonds will give it up dramatically if we see the interest rates start to move higher, the yields move higher across Europe. That happens. Remember, Europe has, and Japan has put a lot of money in, right? So if you got Japan over here, they've put money in. And if you've got Europe putting a lot of money in as well, then you've got all of this that is going to reverse and go back out, primarily to Europe. Should those yields start moving up, you're going to see money come out of here and go into European equities and into debt, and that is going to further push the bond market down. So we've got to watch that very closely. So this is one of the things that we're looking at here. We're watching closely the bond market and see how this reacts. And the other one, of course, that's tied to this, anytime the FOMC does a press conference and they come out with a rate hike, we want to see what the US dollar does, right? Now, you would think logically that any potential rate hike, the dollar would move higher. But look at what happened when they came out and talked about their rate hike right at the jobs number, which all but cemented the potential rate hike right there. The dollar was moving up, and then in the jobs number that said, okay, we're going to have a rate hike, look at what the dollar did. And you would say, well, gee, that doesn't make sense, right? You'd be like, I don't understand this. And what really is like kind of like buy the rumor, sell the fact kind of thing. Well, the rumors, interest rates are going higher, so the dollar's been bought up, and now it's just some profit taking leading up to that. So if we take this out, and let's go back to a 2-hour chart, which is what I'm going to use, you can see here on this 2-hour chart, we had a perfect sell signal up here on this 2-hour chart with the dollar. And that would suggest just lighten the load, take some profits up in this area here. And now we're kind of back down in this support area right here. I think the dollar, and what I think doesn't really matter. We want to see which way the dollar goes. But part of, remember, when you're trading the US dollar, you're not trading like the euro or the pound. You're trading a dollar index, and the dollar index is composed of about six other currencies, of which the euro represents about 57-58% of the entire index. Then you got the yen, you got the Swiss franc, the pound, making up the other part of the dollar index. So when those currencies get stronger, the dollar gets weaker, and vice versa. So we're going to see, even though interest rates going higher, this, I believe, as the pound gets stronger, and it's been selling off recently, but I believe longer term is going to get stronger, and the euro gets stronger, which I think the euro is tremendously undervalued. I think going long euro dollar makes a lot of sense, or going long the euro, because if we look at the, let's go to a daily chart of the US dollar. You can see here on this daily chart, this does suggest near term the dollar can move up to the 103 area near term, okay? But longer term, I believe the dollar is going to be lower at the end of the year than where we are right now, even given the fact that we may have 2 or 3 more rate hikes, right? And it may not make logical sense, but that's where I believe, only because the euro is going to be stronger and the pound will be stronger, and that will push the dollar down. So, and if we look at the pound, the British pound has got the Brexit issues they have to deal with. But look at it here. We're already, with the pound, coming back down to the 2017 low here, which is $1.20 to the US dollar. So, and I don't see any relief yet for the British pound. But I do believe that it will find a bottom, and then it's going to start working higher. So that's what we're going to be watching for. And then, of course, the other asset that I'm very interested in watching is gold. Gold had a key break of both the 50 and the 200 EMA. We broke this upsloping channel very nicely, and now we're at this psychological barrier here, and that's all it really is, of 1200. We break it, the next level is about 1179 right there. We break that and we're coming down here. I'm still sticking to my belief that gold's going to be higher at the end of the year than lower, but near term, we got to keep eyes on it. I want to watch. Traditionally, gold is not like higher interest rates, because as an asset, gold fights for money. And when the money can seek higher returns, dividends, interest, and other asset classes, then you'll see gold sell off. But gold loves inflation. And if we start to give a heavy bout of inflation, you're going to see gold probably move a little bit higher. So these are some interesting conundrums that we're going to see play themselves out over the next 90 days. And then, of course, oil is doing kind of what you know, we broke, actually made a new 2017 low right here with oil at 48.31. We're going to test the 200, or I'm sorry, the 200 EMA. We broke right out of that pattern right there. And if you guys recall, I said if we break to the downside, it'll move quick. We'll test the 200 EMA. Should that break, I think we're going to come down here. I think we're going to come down to this area anyway, somewhere between $42 and $45 a barrel. I think the upside is capped at about the high 50s a barrel, and we're going to stay in this range all year. The risk of a further move lower, I think, will then start to undermine U.S. equities and put some downward pressure on the equities, much like it did when oil got that low before. Remember, oil companies, oil stocks account for a big part of the Dow and the S&P, so we're going to watch this very closely because I do believe that if oil gets into the low 40s, then you'll see the correlation between oil and equity start to increase. So we're going to watch this very closely. We've had 3 or 4 successful trades in oil this year in our secret trader room, and we're probably going to be putting some others on. We're doing very well so far this year. We're off to a strong start. We had a good year last year. If you're not in our secret trader or as a member, I'd highly encourage you to come in and check us out. So these are just some of the ones that we're doing. Now we've got some plays on. We just took a play off in the ag market. We haven't played meats this year, and we've got a couple of things that I'm doing that I'm sharing with my members in the softs market. So, but this is where we're sitting right now, guys. And if you're not a member, I highly encourage you to come in. We're having a lot of fun this year, as always. And I think this week is going to be a very interesting one to see how it plays out. So again, let's watch what Aunt B does at 2:30 in the afternoon. We know odds favor an interest rate hike, but the markets want to hear what she's going to say. Is she dovish or is she bearish? We're going to have a blueberry pie that's full of sugar and butter and fat, meaning she's very dovish, or is she going to give us a new recipe for blueberry pie that changes the tenor of the Feds for 2017? Will be really interesting to see, but the markets are ready. I think we're spring and coiled, and we're going to get some action here coming up in a few days. Otherwise, have a really great weekend. Don't forget to move your clocks forward an hour. It's daylight savings time for those of you in the countries or states that are affected. My favorite time of the year. Have a great weekend, everybody, and I will see our members tomorrow night. Take care, everybody. Ciao.